Hello and welcome to The Print Uninterrupted. I am Dr. Bidisha Bhattacharya, consulting editor for economy at The Print. My guest today needs no long introduction. Neelkanth Mishra, he's the chief economist at Axis Bank, chairman of UIDAI, a member of the Prime Minister's Economic Advisory Council, and a member of TRAI. He has been an advisor to both the 15th as well as the 16th Finance Commissions. So welcome to The Print Uninterrupted. Mr. Mishra, let me get straight to asking you the very first question. Given the current situation in the world around, I would like to start with something that is, it's just been happening. Governor Sanjay Malhotra has also held the repo rate, and of course the RBI annual report is out there. So the numbers coming at India right now are quite serious. Oil has hit $126 a barrel at its peak this year, if I'm not wrong, in April, and it still sits near $99 with ceasefire talks that seem to be a bit fragile. The rupee has also touched 96.61 to the dollar, something that we have not witnessed earlier. And foreign investors pulled out approximately 1.66 lakh crore from the Indian equities. The current account deficit also we've been hearing discussions of the current account deficit widening. In just the October to December quarter of last year, it has been estimated to be around $13.2 billion. So my direct question to you is, are you worried?
No, that's a straightforward answer. There is for someone like me who's been in the market for a while, there's a very natural contrarian bent that you are in a way trained, and you also see the advantage of holding your head when everyone is losing theirs. And I do see a sense of foreboding. If you ask me, there is panic in the currency market, and we'll spend some time on that. But beyond that, I don't see that much of a big problem. But there is this sense of foreboding among India watchers, investors, that something will happen, and as if the ground will shift beneath our feet. The more research I do, the more I get convinced that maybe the worst is being felt, and there is nothing much worse that is going to happen. So allow me to build on that. You're right that at one point oil prices had gone to 126, but that is actually the Brent futures, the next month's futures. If you look at physical Brent, meaning if you wanted access to Brent, say with a 2-week, 3-week notice, it had actually gone up above $140. So there was an outright panic in March and till middle of April. But since then, the physical markets have eased dramatically. So oil prices are now in the early to mid 90s, and this is next month's future. The premium, that is the dated Brent spread over next month's futures, that has collapsed to zero. So basically, the oil markets do not have a shortage, and as of now, physical shortage. And the challenge is, of course, that this is happening because of significant release in inventory. So in the month of April, the release of inventory by countries outside of the GCC was 12.6 million barrels a day. So almost all of the curtailment of shipments through the Strait of Hormuz has been offset by release of inventory from everyone, from the US to China to other OECD countries to Japan. Anyone who had inventories has been releasing it. What this has done is it has, for the oil market, if you visualize a backwardation is where spot prices are higher than future prices. Future prices are lower than spot prices. Um, so it has reduced the backwardation. So the spot has gone down, but the March 27 futures have gone up because the markets think that all the release of inventory will have to be replenished once the Strait of Hormuz really opens up, which means that even after it opens up, the markets will remain tight. What that means for us is that the currency market stresses need our attention. That you cannot assume that the currency market pressures will fade away. So we need some action there. But beyond that, this the need for fuel prices to rise a lot more is not too much. I've seen general news media showing charts that look in Malaysia and Indonesia and US it is up 50 to 90%. In India it is up only 8%. Uh, it is up 8% because there was a 10% reduction in the excise duty, or fuel prices would have been 18% if up 18% if excise duties had not been cut. And The second is that uh, you you also have refining capacity. So India has a refining capacity surplus. The fuel price increases in the rest of the world are occurring or need to occur to a much large extent than in India because the refining spreads have also widened. So to give you a sense of the numbers, when oil price was 65 and diesel refining cracks were $20, you were effectively, I'm oversimplifying, but it were effectively buying diesel at $85 a barrel. Today, oil price, so at one point, oil prices were 105 and diesel cracks were $50. So those countries were buying at $155. So in India, because we have a refining surplus, the need to increase prices is a lot lower because that extra $30, $40 increase that had happened in diesel cracks, for example, is effectively absorbed by the oil marketing companies because which is why even I mean now of course there's no need for further price increases, but even if oil prices were at $100, the need for price increases would not have been more than 4 5 rupees a barrel. So 4 5 rupees a liter. I think that sense that somehow something more needs to happen to adjust for this oil crisis is I think misplaced, which is why I'm not as worried. Sorry, this was a long answer to your short question, but yeah, hopefully that helps.
No, certainly. I think this kind of gives a very important picture or outlook at the growth story, which would be kind of my second question, Mr. Mishra. That the government says that India grew 7.4%, and the RBI's own annual report, which was released just days ago, has confirmed that the number to be 7.6%. Goldman Sachs has also forecasted it to be 6.9% for this calendar year. So the headline numbers look quite strong. And the annual report has been careful about what drove that growth really. I mean, there are charts on private consumption and fixed investment being the headline demand drivers. The report has said, but also has quietly kind of acknowledged that the agricultural gross value added kind of moderated due to weather disruptions, due to net exports, were a drag of 0.1 percentage points. But here is the problem. I would like to just highlight the problem underneath those numbers. If we walk into any mid-sized Indian city, shops are quiet, formal jobs. I mean, at least from the sentiments, formal jobs are hard to find. Ordinary people are not spending the way a booming economy would suggest. There's a goods trade deficit, which I mean is alone standing at say 223 billion in just first 8 months. So my question is this really a broad based growth that people can feel, or is it just mostly government spending money and the statistics following? The RBI annual report has also said that private consumption drove growth, but do you accept that reading? Because consumption led growth and investment led growth are two very different things. for where and they highlight or they kind of chart out as to where India ends up in the next 10 years. So I would like to hear your perspective of this.
Um, Look, first thing first, uh, consumption and investment together are GDP. So you will have periods where investment is stronger than consumption, and you will have periods where consumption is stronger than investment. So it just so happens that at this stage, because the real estate cycle has turned, that the power generation capacity increases are underway, that the investment activity is stronger or is growing faster than consumption. So but that's just arithmetic, right? That's I don't think there is anything, and in fact, uh, I would say from a medium-term perspective, an investment-led growth. So you need to have balance. You can't have a skewed market like China or like the US. So India is somewhere in the middle, and I think it's a happy middle. I don't think it's a very distorted balance between investment and consumption. I'm surprised to hear you say that consumption is weak because even in the month of May, retail sales of cars grew more than 20%. Tractor sales grew more than 22%. In the March quarter, where we have firm data for, say, fast-moving consumer goods like consumer staples, which generally benefit from much more broad-based consumption. There was 6% growth in volumes, which was the strongest in 2 years. We have seen very strong growth in footfalls in malls. After a long, long time in March quarter, retail stores reported very strong numbers. To take you back to where we were in FY25, which is the fiscal year that ended about 14 months back, uh, we had seen fiscal and monetary tightening. So again, another disagreement with your assessment of the economy is that the government is not stimulating growth. The government is being a drag on growth, and it should be a drag on growth because the government has been reducing its fiscal stimulus, a deficit. So as the government shrinks its fiscal deficit, it becomes a drag on growth. Uh, and FY27 is the first year where there is likely to be no drag on growth from the fiscal side. So in FY25, as you know, the fiscal deficit fell from 5.6 to 4.8% of GDP. So there was a 0.8% of GDP drag, which was visible. In addition, there was something on the GST side, which is uh, the GST compensation cess was collected but not spent, which was another 0.5% of GDP. So off-balance sheet consolidation was also about 0.5%. So combine these together, you had a 1.3% of GDP fiscal tightening. And so think about it this way: that an aircraft has the thrust of 900 kilometers an hour, and then you suddenly have a 200-kilometer headwind. Your flight then versus the ground, it's flying at 700. On top of that, because of certain policy errors, the credit growth collapsed sharply. Collapsed in FY25. It fell from about 16.3% year on year to 12%. So it started at 16.3% in March 24, and then by March 25 it had fallen to 12, and it continued falling in the first 3-4 months of FY26 as well. As that happens, as you can imagine, there is a cyclicality, a self-reinforcing cyclicality, in the sense that because credit growth is slowing, there is less money going into the system. That slows down the economy, that hurts sentiments of borrowers and lenders, and that further slows down credit growth. So that was the problem till June, July of last year. Then the GST cuts happened, and the fiscal tightening more or less reversed. And because now the economy was picking up momentum and rebuilding of inventories was happening, credit growth also started to accelerate. So as we entered February, March this year, the economy was growing very strongly. The growth momentum, at least in my assessment, was close to 8% year on year. So the economy has been doing fairly well. And it is not because of government support. The government's fiscal stance today is, well, there's a deficit of 4.3%, but it's unchanged more or less versus last year, which was 4.4. So there's no fiscal boost or drag on growth this year. Monetary is a tailwind. So credit growth is accelerating, or has accelerated. So it is actually helping the economy. The mix of consumption and investment, I think, will remain skewed towards investment. And while in the March quarter, we did see 6% volume growth in FMCG, the consumer staples, which is the soaps and shampoos and the like. My expectation is that growth will continue to lag GDP, because we currently have a surplus of labor. There is significant slack in the economy. We still haven't recovered from the COVID shock. We are about 1 to 1.5 years behind where we would have been if COVID had not happened. And most of that is visible in the slack in the labor market. So there is 1 to 1.5 years of extra workers in the economy. So if you have, as you can imagine, more supply of labor than there is demand, so even if you're growing at 7-8%, if there is slack in the economy and there are extra workers, they don't have pricing power. So it will remain a slightly unequal economy till the time that we've closed that slack.
Mr. Mishra, you've spoken about the unequal economy. You've ended your answer with that there would be unequal economy, and I feel like there's a lot of external shocks and the disruptions that are happening externally, and the energy trap to an extent that has to play an important role in this unequal economy, as we would call it today. Of course, I mean, we bringing the question or the discussion back to oil. The US-Iran ceasefire talks are continuing, but it may take several more days. One breakdown, and we are back to oil prices above $120, for instance. So now, what is a bit worrying is because India imports 88% of its crude, and when oil rises, all import bill explodes. Our import bill explodes because I feel like I call oil as a systemic input. An input that is used in every single sector, and the current account deficit, which is already quite, a significant number, with the goods deficit widening because Indian refiners were forced of cheap Russian oil, by the US trade deal. So that gets worse. So a wider current account deficit will mean that India will need more dollars, and more demand for dollars would mean that rupee would fall further. So a weaker rupee makes every barrel of oil even more expensive in rupee terms. So which widens the deficit even further. It's kind of a loop. And here is also a deeper problem. India's cheap Russian oil cushion is now being wound down as part of the US trade deal. We have lost two energy shock absorbers at the same time. So how bad is this loop according to you? And if the ceasefire breaks down, what does that do to India, really?
Okay, again, several disagreements with your assertion or assessment of the economy. The first is the Russian oil purchases. I think we should avoid getting into the trap of the Western media, just as if the whole economy was running on Russian oil. See, the advantage in dollars per barrel when the war really started, the Russia-Ukraine war really started, was, I think, $15-20 at a gross level, so at source. But because that oil has to go all the way around Europe and then through the Red Sea and then come back, and there is, of course, much costlier insurance because those ships are not insured by the European insurers who have a cartel there. The landed cost, even at the best of times, the advantage was not more than $8-10. By 2024, it had shrunk to $2 or $3 a barrel. So the net advantage was $2 to $3 a barrel. Now, if India imports 1.8 billion barrels a year, and the about 40% of oil was purchased from Russia, which was in the peak of the months 40%, but on average maybe 30-35. But let's take 40% just to be on the extreme side. So you have 0.72 billion barrels. 0.72 billion barrels into say $2, like $2 or $3 billion. I mean, it's a $4 trillion economy. So just because the Financial Times and the Economist and the Wall Street Journal keep saying that India is benefiting from Russian oil and Trump and the US government keep throwing tantrums, doesn't mean that it was the most critical issue for us. It was important for physical security, and frankly, if we had not been buying it, oil prices would have gone up a lot higher. And which is why I think it was important that we buy it. And I think the American establishment also gets it. I'm actually quite surprised and peeved that our Indian media just doesn't get this basic math. That if India had stopped buying it, China would have got even cheaper Russian oil, and so that would be strategically against the U.S. interests, which is why the Biden administration wanted India to buy the oil. Now, when India, under whatever the peculiarities of U.S. policy, agreed that we will not buy, so there was a $2-3 a barrel disadvantage. So as of now, India, because it has a refining surplus, India is not short of physical inventory. See, when the Gulf, the Strait of Hormuz was closed, it wasn't just crude oil shipments that got curtailed. It was also refined products, because Gulf was also about 7 to 9% of refining capacity. Now, given that India has surplus refining capacity, and there are certain types of refineries, like the Jamnagar refinery, which are really complex and can handle, say, even Venezuelan crude, which is generally hard to process. These refineries are running at full blast. And so India imports 120 barrels, consumes 100, and re-exports 20 barrels. So the question of physical shortages of refined products, say petrol, diesel mainly, but also say ATF or other products, is limited to prices. So if there are airlines in India which are curtailing flight schedules, it is because at these prices of ATF, the aviation turbine fuel, some of those flights are not viable. So unless if you start raising tariffs a lot, people will stop flying. So that's an economic justification. It is not because of physical shortage. So physical shortage is perhaps an issue with LNG, the liquefied natural gas. There was a 2.5 month issue with LPG, liquefied petroleum gas, which is propane and butane. Even that is starting to get addressed as the refineries have changed their mix. And otherwise, physical shortage is not an issue. Now, how serious is this issue for us? It is a serious issue. It's not just about 88% of our crude oil imports in total, because we import a lot of fertilizer, we import edible oil, we import gas, we import crude oil. So a $15 per barrel increase in oil prices is a $40 billion impact on the Indian economy. Is what we call a terms of trade shock. And that is 1% of GDP. So if last year's base price or the last year's average price was $70, if oil prices average $85 a barrel, there is a 1% of GDP terms of trade shock. If oil prices average $100 a barrel, there is a 2% of GDP terms of trade shock. If it goes to 115, it's 3%, 130 means 4%. So these are substantial numbers. And there will also be non-linearity, meaning that beyond a certain increase, it will not be a straight line. I mean, it could be, the impact could be much worse. So let's assume that, till the time that oil prices were 100, where were we? Now, in the first 2 months, the government was providing significant amount of fiscal support. So the government has promised the farmers that whatever happens, urea will keep selling at 5.3 rupees a kilo, that DAP will also get subsidies, and for a while, there were no increases in petrol and diesel prices. Now, in our estimate, in those 2 months, the government's cost, fiscal cost, annualized was about 1.2% of GDP. So if you take that out, meaning there was a 2% terms of trade shock because oil prices are averaging $100. And as I mentioned earlier, on the refining side, whatever margin increase has happened globally is a wash for us because we have our own refiners. That's not a loss
Yeah.
to the economy. So if there is a 2% of GDP in terms of trade shock, about 1.2% was the fiscal buffer, and 0.8% was flowing through to the economy. So
Okay.
some chemicals prices had gone up, plastics prices had gone up, plastic furniture manufacturers had to shut down because they couldn't. I mean, there was no demand for furniture, which was 50% more expensive. So so we started at 8. We slowed down to 7.2 because the government was absorbing about 1.2% of GDP worth of terms of trade shock. Over the past month or so, the government has raised prices of petrol and diesel by about 8 rupees a liter. Uh, India consumes about 16,000 crore liters of petrol and diesel. So if you just multiply that by 8, you get about 1.28 lakh crores, which is give or take 0.3% of GDP. So now that the petrol and diesel prices have also been passed through, the 7.2 becomes 6.9. So, but if oil futures markets are right, and at some point the oil markets do open up, so March 27 futures prices at this stage are at $80 or so, maybe slightly lower. Then the headwinds will fade away very sharply. So the economy, as the strait reopens, can actually start reaccelerating again. So that's the way to think about it. And as I would reiterate that sense of foreboding that something somehow is about the crisis is not reflected in the Indian economy. I think that's a misplaced fear at this stage. What I do worry about is that the the release of inventory by the major OECD nations, by the US, by China, also cannot last forever. So maybe at most, maybe 3 4 months of further inventory may be left, and as that starts to near, the markets may start panicking again. So one hopes that this agreement happens because as of now, the relative calm in the market is a reflection of significant inventory releases, and that cannot sustain forever. So that's the only thing I worry about, but that's more a global concern than a very India specific concern.
Um, Now that I've been expressing this concern, but there's one another concern that has been quite strongly voiced in the media about foreign portfolio investments, to be specific, FPIs being pulled out. So my next question would be around this. It would stay around the rupee specifically because I feel like the rupee is where it all is kind of coming together. We've spoken earlier about the rupee touching 96.61 on the May 19th, and these are levels that we have not seen earlier. The RBI has been selling dollars to defend it, and in March alone, the RBI sold approximately 29.6 billion dollars of foreign currency on a gross basis. And the annual report released this week tells us that just how expensive that defense has been. The RBI's balance sheet expanded over 20% to nearly $92 trillion in 2026. And now adding on to this foreign investors, adding them to the picture, FPI is pulling out a record of 1.66 lakh crore from Indian equities in 2025. That selling has dramatically accelerated, at least in reports, in 2026, and FPIs have now pulled out over 2.25 lakh crore in 2026 alone, which has already exceeded the full year record that was just set last year. Um, So, I mean, domestic investors and SIPs have held the Sensex and Nifty to, I have to, I mean, speak about this, that to only about 3% below the pre-war levels. That is genuinely remarkable resilience. But the story behind the headline is that foreign capital leaving at, historic scale, and the RBI is burning reserves to steady the rupee, and the current account is under pressure. So my question is, when foreign investors leave, the rupee falls, and when the rupee falls, oil again costs more, and we get into the inflation picture. The inflation rises, the current account widens. So at what point does this become a crisis the RBI just simply cannot manage with just reserves alone, and what can break this loop according to you?
Um, I think this market needs crowd control measures. See, you can perceive a sense of panic, and I'll try to quantify that in numbers. Uh, Again, the characterization should not be, because this loop that you just described is, see, the balance of payments is always done in dollars. So whether rupee falls or rises, it actually is not very relevant. What does matter to OMCs is, of course, that if the rupee falls, then their perceived losses go up. But that's a few percent point here and there actually is less important, because oil movement is far more important there. Now, in the currency market, and we'll come to FPIs after that. In the October to March period, so October 2025 to March 2026 period, the balance of payments deficit was about $24 billion, meaning we'll get the BOP data for March quarter in a day or two, but our estimate is that because BOP data is on an accrual basis. So what happens is, when a company says I'm exporting $100 or something, the BOP statement books it at $100. Now, whether that dollar comes in 15 months later, because the accounting rules and the accounting norms and RBI's rules allow companies to collect that money up to 15 months later. And once you've collected it, you can still keep it out for a month. So the BOP statement is on an accrual basis. So suppose I import $100 of metallurgical coal or some resin, then that is accounted for as import. Now, the fact that I may have hedged it and I may have paid for it 6 months back, or I may decide to pay it 6 months later, all of those are not visible in the BOP statement. So on that basis, our shortfall of dollars, which is called the balance of payment deficit, that is, there was more demand for dollars than supply, was $24 billion over the October 25 to March 26 period. But in that same period, the RBI had to intervene by more than $70 billion. So the question to ask is, if on an accrual basis, you only had a shortfall of $24 billion, why did the RBI have to intervene by more than $70 billion? It is because people have been speculating on the currency. And this speculation is not some evil macro trader trying to short the currency. The speculation is being done by people, by companies who are panicking themselves. So there are importers who are worried that the rupee may keep falling, and therefore they go and hedge. When they try to hedge, they increase the demand for dollars. Exporters are worried that the rupee may keep falling, and therefore they're keeping the dollar out for longer than they used to. And in the process, they are actually worsening the pressure on the rupee. So it is this sense of panic which needs to be stemmed, because if you have $700 billion of reserves, then a temporary 6-month or a 12-month disruption in demand supply for dollars, that's the whole point of having reserves, that you shouldn't have to change your policy or panic. The problem has been that because of continuous negative messaging around the currency, everyone has started panicking. And if the more people panic, in the near term, the currency really has no fair value, and therefore the rupee keeps falling. So that has been the problem. How do we solve for this? I think the first step was to let fuel prices at the pump go up, because the currency markets had been panicking that oil prices have gone up, refining margins have gone up, but domestic retail prices have not gone up, which means that all the burden of adjustment on the balance of payment side will have to be taken by the currency. The moment you start signaling that no, retail prices will go up, whatever demand adjustment needs to happen, at least will happen, it takes some pressure off the currency market. Then the RBI has been quite aggressive now in defending levels, which I think gives the right message. And at least at the margin, people are who are panicking will start thinking, okay, you know what, RBI will manage it, and the rupee is not weakening anymore. And the more it is seen as, say, a 94, 95 level stabilizing, the less the likelihood that more people want to try to go and hedge. It is quite possible, as you said, if the war reignites, it becomes kinetic again, meaning missiles, of course, they've been flying around, but not in a very aggressive way yet. But if and if the, like what the Iranians were threatening last night, if they do close the Red Sea route completely, then the oil prices can go up dramatically. Now, the only solace I would see at that stage would be that it would hurt the world as much as it hurts us. Maybe it'll hurt us slightly more, but $120 oil, I don't think the world can take for very long. So which is why it is very unlikely that that stage stays there for a very long time. But if it stays there, then we need to have buffers in place. And those buffers, as I was mentioning earlier, would be like crowd control measures. So what you do is give a signal that you can get, or that India can get, maybe 50 to $100 billion of capital flows over the next year or two, which could mean a mixture of a variety of various of schemes. So, for example, you could cut withholding tax on bonds, which could help your inclusion into bond indices. You could cut withholding tax on external commercial borrowings, in which case Indian banks or Indian corporates could raise dollar debt, and so then the much needed dollar flows will start happening. Our external debt as a percentage of GDP has actually come off very sharply. So it's absolutely not a solvency problem. It is purely a liquidity problem, and it can be solved with liquidity measures. So it is an adjustment that we have to undergo. Now, if oil prices are going to be $120 a barrel for the next 2 years, then yes, the rupee needs to fall. But as I was saying earlier, I think the world may not be able to take $120 oil for a very long time, and therefore some kind of agreement will come.
Um,
Sorry, FPI side, to close that loop. See, there are four things that have happened. The first, till about a year back, maybe till about a 6 month back, uh, emerging markets as an asset class were not seen as very attractive. So a very large part of capital flows into India, so a foreign portfolio investor capital flows on the equity side, uh, uh, occur through emerging market and Asia funds, and these funds have not been doing too well. And therefore, asset allocators who are usually, I'm not commenting on their intelligence, I'm just commenting on their behavior, they're usually backward looking in their allocations. And therefore, if EM funds were underperforming, had been underperforming for a long time, EMs was not a good asset class. Last year was the first year where they beat US markets in performance. So this year, some flows have started. The second big factor was India itself. As I said, in FY25, we did fiscal and monetary tightening at the same time. So India had the worst earnings revision among all major markets. Because if you forcibly slow down the economy because of fiscal and monetary tightening at the same time, obviously investors get disappointed, because you expected a certain earnings, and then you see a double-digit revision, downward revision to those earnings. It is disappointing, so they went away. But because the fiscal and monetary tightening is now mostly over, monetary is actually a tailwind, meaning it is easing. It is supporting earnings, so that also is less of a negative. The third factor is that in 2022-23, India was benefiting from the TINA factor. There is no alternative factor, which is that at that time China was seen as uninvestable. Russia had just attacked Ukraine, so they had been banned from the EM indices. South Africa had power outages. Argentina was struggling with bankruptcy. Brazil had massive political issues. Mexico actually hasn't grown per capita GDP for 10 years. So when you look at the EM universe, India was like the shining star. Today, Brazil has turned around. South Africa now has bank surpluses. China is investable, and of course, there is the semiconductor cycle, which is benefiting many countries, including Japan. It's not an emerging market, but it is a big market, and India is not part of it. So this is the third factor. This, of course, is not going to change anytime soon. There is a fourth factor which has hurt us and China both. So all countries that are energy importers have seen significant outflows in the last 2 months, to the extent that China is now starting to tighten overseas directives. So basically, China's companies are investing abroad, and they're starting to put controls on that so that they can save their own currency. So this oil-related stress, of course, has been there across markets. But my sense is that if oil prices remain at $90 odd, though ideally I think 70 would be much better, but 90 is not healthy, not for the world, not for India. But I do think that this will. So this is not something which is a big judgment call that somehow India, somehow some white-skinned guy understands India better than Indians sitting in India, and therefore their opinions should be respected, and somehow we should start giving capital gains tax cuts and all of that. So I think those kind of assertions, I'm not saying we should or should not give capital gains tax cut, but this whole narrative that is being spun that somehow the FPI selling India is like a big negative report card for the overall economy is not a narrative that I agree with.
Thank you for clarifying this, Mr. Mishra. Here, I'm a little tempted to ask you one question because you chair UIDAI and you sit at the center of India's, digital financial infrastructure, Aadhaar, UPI, account aggregators, fintech lending. And India has built something extraordinary in this area, and credit is now reaching places that it has never reached before. But I want to ask the question that is usually not being discussed. The RBI's own financial stability report has shown numbers such as stressed assets of NBFCs in the microfinance sector rose from 3.9% in September 2024 to 5.9% in March 2025. And write-offs for upper layer NBFCs, the large ones, they surged to nearly 73%, and bank NBFC interlinkages have deepened to the point where nearly 80% of bank acquired retail assets came from a limited set of non-bank originators. So when credit grows very fast and reaches first-time borrowers and is delivered through apps that make borrowing feel very frictionless and almost invisible, sometimes there's a chance that that might end badly. We're not just seeing any early signals anymore. RBI's own non-banking stability indicator has risen, from its 8-year low. So my question to you is, are we building something that will genuinely transform lives, or are we just quietly setting up for the next credit crisis, and one that, when it comes, it will hit people at the bottom the hardest? This was my question to you.
The first thing is that people at the bottom, most surveys show are usually in debt. So if you do the profiling of by income percentile, the observation would be that the top 20-30% are net savers. The next 30% maybe are neutralish, meaning they consume what they earn, and the bottom 30-40% or maybe 30% are usually in debt, so their expenditure is generally higher than their incomes. Uh, the question is, what type of debt are they taking and what kind of interest are they paying on them? The effort of the Indian financial regulation has been to extend the formal financial system as much as possible, so that because in the informal market, interest rates can be quite extreme, so 2% a month, 3% a month, whereas in the formal financial system, the rates are not low. I mean, 18, 20, 24% sometimes, but they are, at least there is regulation, and so the objective is to make formal credit more available. The objective is also that you allow people to use the assets that they have as collateral. Now, given that most of them don't have physical assets which can be valued at scale and lent against, this is where the account aggregator model that you mentioned becomes very handy. So if there is a small shopkeeper or a small vendor who has UPI transactions and a certain trail of UPI transactions and a certain pattern of UPI transactions, meaning there is a certain future projection that can be made basis past transactions. How scalable is the system in terms of offering and evaluating, offering loans to them and evaluating their credit worthiness? And so that has been the holy grail. The industry and the regulator have been at it for more than a decade. Some things have worked, some things have not worked. So, like for example, lending against GST or GST invoices. So this was the biggest advantage of the new GSTN, because the suppliers upload invoices which are then validated by customers, and those validated invoices can then become proofs of revenue which financial firms lend against. And so banks and NBFCs all lend against them. So those have been proven to be much more trustworthy. There are financial models at the micro lending side, meaning the fintech and algorithmic models, where there is a certain process of, I would say, evolutionary selection. So people experiment with different models. Some of those models work, and the ticket sizes keep going up. So they start with 5,000, and they're successful. They go to 10,000, and they go to 20,000. And now some of them have reached 1 lakh also. And the models that don't succeed, where the non-performing assets, the non-performing loans, the stretched loans go up to a certain level, then those models get discarded. The data that you quoted was indeed a problem in FY25. If you recall, the credit growth was decelerating. In fact, till about June, July of 2025, credit growth was coming off. There was stress on the borrower side, there was stress on the lender side. But once the economy started accelerating, the NPA levels in the non-performing asset levels in the NBFCs have also come up. So if you see the March quarter results, they've actually been quite encouraging. In fact, the financial system as of today, so if you see the same result for March 26, because that's much more current, March 25 is 14 months back, the current system is actually much healthier, and that, I would say, was a blip that we've now come out of. Because as much as it is tempting to say that whenever an NPA occurs, that it is bad lending, very often what happens is that you make a loan basis a certain assumption on the economic growth, income growth in the economy, growth in a certain sector. And if that economic growth fails to manifest itself because of policy errors, because of, say, global pandemics or these kind of wars, then those loans go bad. And So in FY25, there was some necessary correction. I think the MFI ecosystem had, I think, overgrown. In 2 years, outstanding loans in microfinance had gone from 2.5 lakh crores to 4.5 lakh crores. So if you have 80% growth in 2 years, there's bound to be some problems. But I think that cleanup has happened. So it was a very, I would say, narrow problem, meaning it was in small pockets. There was MFI, there was some unsecured personal loans, certain types of retail credit which had, I think, problems. Those had to be cleaned up, but as I was saying, those have been mostly cleaned up. So as of now, that is not a stress area.
Mr. Mishra, thank you so much for such an honest conversation. This is exactly what we intended to do. And I mean, from the responses that you've given and from what we've heard today, it feels like the Indian economy's strengths are real. Definitely, the pressures are real too. But these are not reasons to panic. They are reasons to think clearly, to demand honest answers, to look deeper into the data, into different aspects of the data as well. And thank you for giving your perspective on such varied questions and topics. And thank you for your time. To all those watching, those of you watching, thank you for being on The Print uninterrupted. Thank you, Mr. Mishra.
Thank you, Manish.